Hello, Jason Bates here, owner of Electrum Financial, a mortgage broker located right here in beautiful Cave Creek, Arizona, where a mortgage is not a flip of the coin. So if you're looking to purchase or need to refinance, I would like to be your broker of choice, as I have access to the lowest rates at the lowest costs in Arizona. And if you don't believe me, call me. Yesterday was the last day of the month and quarter. That means more for financial markets than it does for many other sectors. While there's no hard and fast rule concerning timing, there is historically increased trading activity at the end of the month and quarter as various types of money managers rebalance their portfolios or adjust their holdings to match underlying benchmarks. It's fair to say that a good amount of the bond market weakness in the past 6 months has included the assumption that some combination of stimulus/spending would account for several $1 trillion of additional bond market supply. Now, bond market supply is bad for rates. Higher rates equals lower prices equals higher yields. All other things being equal, of course. It's actually double whammy in the case of the COVID relief and stimulus/infrastructure, as that spending would ideally promote a stronger economy and higher inflation. Two other things that are really bad for rates. Now, this is a very popular narrative right now, and in general, anytime rates are rising or at the risk of rising, inflation is certainly important to bonds. But is it perhaps more important than it should be due to the lingering trauma from the 70s, 80s style hyperinflation? Almost certainly. That's been one of my key talking points in the past, as inflation has remained in check despite episodes of panic. If there was a time for inflation to make a meaningful comeback, 2021 through 2023 is the best chance we've had in decades due to the combination of supply-side constraints and fiscal/monetary easing. That's the foundation of the inflation thesis anyways. I don't necessarily agree with it, as there are other factors that are continuing to push back in a disinflationary direction. Ultimately, all that really matters is reality and how traders are trading it. With that in mind, let's look at a few charts that can help us make sense of inflation versus rates in 2020 and 2021. Each chart contains two lines. The blue line is the inflation expectations based on the yields of inflation-protected treasuries. All you need to know about the blue line is that it shows how traders are actually betting on inflation over the next 10 years. The yellow line is simply the 10-year treasury itself. Now, to be sure, inflation expectations were well ahead of the rise in yields in 2020. A case could also be made for a little pop in December, leading to the 10 years similar pop at the beginning of January. But if you watch my videos regularly, you know that was all about the Georgia Senate election. You might also already be noticing that the yellow line seems a lot steeper in 2021 in general. If so, the next two charts won't be a surprise to you. I'm simply going to choose different start dates to emphasize the discrepancy. Let's start with April of 2020. Now that makes it even easier to see, but we can do better. How about January of 2021? Now the yellow line is above the blue line, and we can see a clear jump in mid-February for the 10-year yield. But if we go back to February 16th, we find the following. U.S. stimulus on track to be bigger than expected. That was also the week following the conclusion of the impeachment trial, which allowed the Senate to approve the $1.9 trillion stimulus package. In other words, we had $1.9 trillion sooner than expected, and talk of additional stimulus followed only a few days later. Now the charts and news make a strong case for Treasury supply being a key driver. Unfortunately, it's difficult to fully separate from the COVID narrative because case counts were plummeting to the bottom of their range on the same week, and vaccination counts were ramping up. Either way, I can say this. Trading levels do not yet suggest inflation has shown up in a scary enough way to be responsible for the rate spike in February and March. The takeaway is that the leveling off of the decline in inflation in the future would be limited in terms of its ability to promote lower bond yields. The bigger benefit would be a drop in supply. So there you have my take on the rate spike in February and March. If you'd like to know more, reach out to me. I'd like to meet you, that's for sure. Thanks for watching, and if you're looking to purchase or refinance a home in Arizona, I would like to be your broker of choice. Until next time, take care and stay safe.